Good morning and thanks so much for tuning in. You're watching Trade Talk on BQ Prime. My name is Mathew and with me is Hiral Dadia. Morning, Hiral.
Good morning, Alex.
I hope, first of all, that everyone had as good a weekend as the Indian cricket team. And I hope that you enjoyed the match over the weekend as well. As we head into trade, though, at the start this week, you have safe haven assets across the world that are in focus as that conflict between Israel and Hamas. The worry is that it will escalate and move to other regions. Of course, the US and allies are stepping in to try and ensure that doesn't take place.
Absolutely. And when you talk about the impact, crude again back above $90 per barrel. Gold is inched higher as well, right? Okay. So across, and treasury yields as well. So all of these macro, from a commodity perspective to a market perspective, is having an impact. And that's something which is actually making investors also pretty jittery.
Certainly. And dollar and yen as well, while they're stable at the start of the week, they have been in focus as safe haven bets. And what Hiral was pointing out, towards the end of the week, last week, you saw gold prices hit a 3-week high, despite the pressure of higher treasury yields. So that tells you something. Of course, risk assets across the board in Asia are lower at the start. 3 early rises had started lower. And of course, this week, there's going to be Chinese growth numbers to watch out for and certain rate decisions as well. But for now, let's turn attention to the Indian equity markets. You saw very narrow cuts at the end of the week last week, and you saw buying, interestingly, by the foreign institutional investors. So a little bit of a conflicting sign.
So there is a conflicting sign, but if you see in the month of October itself, Alex, there is selling, right, by FIs. If this buying continues, then probably you could see some bit of, positive momentum, see a tide turn. But a one-day scenario will not really tell us a lot about how the FIs are expected to behave. Clearly, you're seeing Nifty as well. We went in below the 19,800 mark again in terms of Friday. If you see the Sensex as well, 66,300 is what we've been tracking closely. Sectors, your banks, IT, media, as well as metals. These were the ones where we actually did see a lot of selling pressure, whereas real estate and pharma continues to shine. In fact, real estate continues to be the interesting one of the lot as well. Let's see how much the festive season gives it a boost as well. Sure. And you have the consumption sector, which is going to be interesting. But if you have to look at the levels, still that 19,800 is becoming a key hurdle. And I think Agam know better than him to tell us what the F&O action is actually indicating in terms of, what levels we should be watching out for. Good morning, Agam.
Good morning, Hiral. So directionally, it's been a very tough market to trade. We saw the Nifty bounce back just about three sessions away. The weaknesses once again started seeping in because of the geopolitical tensions in West Asia. And on account of that, we're seeing a step forward, a step backward. And on the whole, there is a lot of unpredictability. That said, your option premiums have also moved on slightly on the higher side because of that uncertainty with respect to where the markets are headed. At this moment, what we're seeing is the Nifty open interest declined by around 3.7%. But remember that we were starting to see just some amount of longs building in. And after that, we're starting to see that profit booking coming through. And as far as the Bank Nifty futures is concerned, we saw an up move around 10.5% in open interest, even as the Bank Nifty closed lower. Hence, we've seen shorts building into the system. Coming down to the Bank Nifty, of course, we're keeping an eye on 44,300 call specifically. That's where we saw a lot of writing coming through, and the 44,500 put also is quite active. And that said, in terms of the Nifty, once again, Hiral just mentioned the 19,800 mark. It's going to be crucial. Should we see the Nifty take over that mark and sustain above that, there's a likelihood of strength coming through. But on the other hand, it's also looking at just a tad unlikely given the kind of uncertainty. For now, at least as far as the data is concerned, benchmarks are in consolidation mode, and a direction we'll have to wait for more data points to come to arrive at what direction the Nifty is going in.
Certainly. Thanks so much, Agam, for bringing us those updates. In Bank Nifty, as Hiral pointed out at the start, was under pressure on Friday. It was down about 0.7%. And of course, the IT pack on account of results. So you might see some action this week as well on the back of results. And to start with, we're talking about HDFC Bank, the big one to watch out for. And it has had the propensity to move the benchmark index ever since it started trading together, HDFC Bank and HDFC. But let's talk about the key monitorables about the Q2 earnings. We've got Mimantsa joining in to give you some perspective, and then we'll go to our guest for the day. Mimantsa, what you're picking up?
Hi, good morning, Hiral. Good morning, Alex. So the provisional figures that came last month have shown that the bank has shown a good growth in deposits, but the net interest margin and the return on of assets is a key monitorable right now. Now we have to bring in the merger impact here. The merger came into effect on July 1st, but the excessive liquidity along with the RBI's ICRR move has had an impact on return on assets. So the analysts are expecting a 15 basis point deviation in the return on assets from the long-term average of 1.9 to 2.1%. Now this is likely to go on for next few quarters, but this will be a key point to watch out for in today's earnings briefing. What is the likely path to normalization, and what is the timeline of ROA returning to normal is going to be watched out for. Other than that, the bank has shown recent surge in priority sector loans, particularly in the Rural Infrastructure Development Fund. But bank has also shown growth in agri loans, aggressive growth in agri loans. So this raises a few questions on how the bank plans to meet its PSL requirements under the merged book, and more importantly, if offsetting the PSL requirements is going to lead to one-off departure from long-term ROA or not. Coming to the NPAs, HDFC's non-retail book has shown higher share of bad loans. Even the management last month has pointed so, and they're expecting bad loan ratios to worsen marginally due to the merger. So we'll have to watch out if the continued rundown would bring along the spike in provisions and write-offs, and how bad the asset quality of that portfolio is going to go on in the next coming quarters.
So thanks, Mimantsa, for getting us the details. In fact, it's going to be interesting to see if this is already priced in terms of the stock or not. But let's quickly welcome in our guest to understand what's in store. Rahul Malani, research analyst at Sharekhan by BNP Paribas, joins in. Rahul, good morning and welcome to the show.
Good morning.
Rahul, Mansa was taking us through the key numbers and the factors we will be watching out for. And from a number perspective, clearly, we are not comparable, taking into consideration that the merger took place on the 1st of July. However, a worsening in terms of asset quality is what we're looking at. Provisions are expected to spike as well. How are you treating the numbers, number one? And is this something which is priced in according to you?
So first of all, we are not unduly worried about the asset quality. Overall, asset quality continues to be benign. Most important trajectory would be the net interest margin. We believe that net interest margin would be under pressure for at least next 2 to 3 quarters. Because if we look at the opening NIMs of the HDFC Limited erstwhile, they are significantly lower than what they had been reporting at the standalone level, because of the additional liquidity, excess liquidity which they are supposed to be carried. Additionally, they have during the quarter they had an impact of incremental cash reserve ratio, norm which was imposed by the RBI. So overall, we believe that NIM's trajectory would be important to track, which will unfold the post-merger ROA for the FY24. So important monitorable would be to track the NIMs and overall ROA post-merger which they would be reporting, as well as the impact of net interest margin, how much it is structural and how much it is transient. Because if we look at the current quarter, we expect NIMs to be around 3.5% versus the standalone HDFC Bank used to report at 4.1%. So overall, 60 basis points dip in the NIMs. So overall, that much impact should be seen in the ROA levels also, and this has led to some de-rating in the stock when compared to the peers. So overall, NIM's trajectory as well as what is the amount of structural nature changes in the NIM and what are the transient, that will depend upon the future trajectory.
So you've said to a certain extent this is priced in from what I understood from your answer, and you've also described what according to you would be an acceptable level for the NIM as well. But if you can splice the loan book for us, I think that's where I think there's going to be a little bit of interest as to how they're going to manage their priority sector lending. For example, there is certain pressure in the unsecured book. We'll come to that, of course, for the sector as a whole. But what specifically are you looking for when you splice that loan book and you try and understand where the growth is coming from for HDFC Bank? What is acceptable to you?
See, for a bank like HDFC Bank, there is nothing challenges in growing the loan book. But if you look at the main challenges on the liability side, if you look at the industry trend of the credit deposit ratio, which is higher at 1.8%. So, in order to normalize that level, it will be difficult for the bank to report high mid-teens growth, the 70 to 80% loan growth, which with the other analysts are estimating in the numbers. We believe that 12 to 13% loan growth will be a new normal at least for the next 2 years in order to bring back the normalized CD ratio for the HDFC Bank, and that will be the more important factor for the bank right now. And we do not see any challenges in growing any of the segment for the bank.
Right. So this is going to be interesting to watch out for, because more than this quarter earnings, the future trajectory is something that one needs to eye as well to understand where we could be moving. Because as Rahul is mentioning, there has been significant derating that has already been priced in. But moving to the overall sector as a whole, an interesting aspect that everyone's talking about on the street right now is with regards to higher credit costs on the unsecured loans of banks. Now, there was a UBS report last week as well, which was indicating that the credit losses are likely to spike by 50 to 200 basis points by FY25. And this is on the back of unsecured loans. What's the sense that you pick up? What is your view on the same, Rahul?
See, here we believe that there will be FY23 was an exceptional year. FY23 and 24 are one of the exceptional years where the credit cost has been very low. We expect certain gradual normalization in credit cost in FY25. But anecdotally, if you see the majority of the asset quality stress in the retail book, or if you look at the unsecured book, where anecdotally we have seen historically when there is a sharp economic downturn in an economy, as we have seen in 2008 and 9 and recently seen in COVID. At that point of time, we saw certainly a spike in the retail NPAs as well as in the unsecured books. We believe that more important factor is to look at the customer pyramid here in order to understand. There is no doubt that in last 2 years there has been a strong growth in the unsecured portfolio across the industry. If you look at the pyramid currently, which is seeing stress, is the lower ticket size unsecured loans below 50,000, and these are mostly catered by the fintechs. So overall, if you look at the customer pyramid, first of all, the stress will emerge in fintechs, then NBFC, then private banks, and then in PSU banks. Because if you look at the composition of the PSU bank unsecured book, they cater almost 95% of the total book is given to the salaried and government employed. So it is in near term there could be here a spike, but eventually the credit loss will be negligible in that.
Okay, I get the point. But last question from our side, which is, and you've pointed out the implications of that unsecured lending for the various categories of lenders, right? So from the standpoint of the earnings trajectory going forward and valuations as they stand right now, what according to you is the best pick if you broaden the horizon to also include PSU banks as well as NBFCs? So private banks, PSU banks, and NBFCs.
So in private banks, we believe that IndusInd Bank and Federal Bank are near. Federal Bank remains our top pick. IndusInd Bank is likely to outperform the sector in terms of earnings growth also, and valuations are also reasonable. In terms of Federal Bank, valuations are definitely reasonable versus the return assets return trajectory which the bank is going to show. In terms of PSU banks, we like lower DI PSU banks where there would be substantial improvement in the ROA in the H2 of FY24 and for FY25 onwards. So we like Bank of India and Punjab National Bank in there. And in terms of NBFC, we remain positive on Cholamandalam Finance, Bajaj Finance, and Five Star Finance.
Right. Thanks, Rahul, so much for getting us the details. So I think these are a few of the stocks we should be watching out for. And HDFC Bank remains one of the key stocks in terms of today's session as well. But moving from a HDFC Bank to a HDFC Life now, clearly Mika is standing by to get us more updates and what brokerages make out of the earnings as well. Mika, good morning. What do you have for us?
Good morning. So to start off with, HDFC Life's board has approved a reclassification of ABRDN, their Mauritius holding, from promoter to public category. Post reclassification, HDFC Bank will remain the sole promoter of the holding. The companies also posted their investor presentations highlighting more about the business performance this quarter. While the company's revenue did remain unchanged at the 23,018 crore mark, their overall market share in the first half now stands at 10.3% and 15.7% in the private sector. The company did outpace the private industry based on their total new business growth and enjoyed continued leadership in the sum assured category with a 28% protection growth. We also have some brokerage view on the company's performance. First, we have CLSA. They upgraded their rating to overperform and revised their price target upwards from 600 rupees previously to 725 rupees. The brokerage believes that the stock's recent correction will offer more upside. CLSA stated that HDFC Life's performance in FY24 was due to two opposing themes. The first one was a rise in HDFC Bank's counter share, but a decline in high ticket policies. And the second one they highlighted was higher sales in ULIP and a pickup in protection, but a decline in non-par saving segments. The brokerage also stated that the flat valued new business margin of 26% was driven due to higher sales, but on low margin products. It expects a 6% annualized premium equivalent growth in FY24 and 14% in 2025 and 2026. We also have Jefferies that maintained their buy rating at an 800 rupees target price as the stock continued to be one of their top picks. The brokerage was encouraged to see an increase in HDFC Bank's wallet share to a higher 65% according to Jefferies in Q2. Moreover, Jefferies believes that the improvement in the agency channel will help deliver 18 to 20% premium growth over the second half of FY24. The brokerage also expects an AP and valued new business growth of 19% over FY24 to FY26. And lastly, we have Macquarie that remained neutral on HDFC Life with a 556 12-month target. The company's 3.6% year-on-year growth of new valid business was lower than the brokerage's 9% estimate, and HDFC Life's ask rate, according to the brokerage's calculation of 2,550 crores for the second half, seemed challenging, said Macquarie. However, the brokerage does think that HDFC Life's counter share growth to 62% versus 57% in the previous quarter is encouraging.
Certainly. Thanks so much for bringing us those updates, Ameka. And private insurers, of course, life insurers have been gaining traction of late. They have been taking a larger share of the pie. SBI Life, of course, has been the pick of the lot, taking up most of the incremental market share at the cost of Life Insurance Corporation of India. Let's focus on earnings, though. We've already spoken about HDFC Bank, but there are quite a few companies that have already posted their results. And one of them that we're focusing on that could be active in trade today is Avenue Supermarts or DMart. It saw a decline in the net profit, in fact, and a miss on the consensus estimates. We're joined by Varsha to talk about Avenue Supermarts and a number of other stocks. Morning, Varsha. What are you picking up?
So, as you stated, so let's start with Avenue Supermarts, famously known as DMart. So, the revenue for the company rose 19% to rupees 12,624 crore. Now, this was compared with an estimate of rupees 12,486 crore. Now, the operating profit was up 13% at 1,004 crore versus the estimate value of 1,094 crore. Now, the margin narrowed to 8% against 8.4%, while analysts had pegged the metric at 8.8%. Now, the company's gross margin continued to be lower compared to the same period in the previous year due to lesser contribution from the higher margin general merchandise and apparel business. Next, we have Som Distilleries, where the revenues were up 74%, while the EBITDA was up 57%. Now, margin was at 5.83% versus 6.44% due to increase in material cost. and net profit was up 80% at rupees 14.85 crore. Then we have Den Network, which saw revenue decrease of 3% at rupees 276 crore, and EBITDA was up 14% due to lower employee cost. Also, the EBITDA margin was at 15% versus 13% last year. Though there was 33% increase in other income, the net profit was down 5.2% at 45 crore, as there was deferred tax expense of 18.3 crore versus 0.4 crore last year. Then we have Tata Steel Long Products, where the company saw its revenue soar 57% at 2,947 crore. EBITDA was at 93 crore versus EBITDA loss of 255 crore last year, as there was decrease in its material cost and employee cost, where it incurred a net loss of 460 crore as against 661 crore in the same period last year. Then we have Dalmia Bharat, where the revenues were up almost 6%, and the sales volumes increased by 6.6% to 6.2 million metric tons. Now, EBITDA was up 55%, which beat the estimates. Also, there was decrease in power and fuel costs of 25%, which led to increase in EBITDA margin of 19% versus 13% last year. And there was increase in net profit of 161% at 123 crore versus 47 crore last year. Also, there was increase of 2.5x in other income, but this was offset by increase in finance cost by 1.87x. Then we have Texmaco Rail, where there was increase in revenue of 66%. EBITDA was up 75%. There was increase in material cost, which was offset by decrease in employee cost. Due to this, margins were at 9.4% versus 8.95% last year. And net profit was up almost 70% at 20 crore. Lastly, we have GTPL Hathway, where there was increase in revenue by 18%. Also, there was increase in subscription revenue by 16% year on year. And EBITDA was down 5% at 124 crore, which led to decrease in margin at 15.95% versus 20% last year. And also, there was decrease in net profit by 24% at 35 crore.
Right. Thanks, Varsha, for getting us the numbers. And interesting is going to be Avenue Supermart as well as Dalmia Bharat. Dalmia Bharat is an interesting number to watch out for as well. Thank you for getting us the details. Moving on, a couple of companies that have seen order wins over the weekend. And apart from that, a lot of other companies that will be in focus as well on the back of other news. But let's start with the order wins. Rishi is standing by to get us more. Which are the companies that have seen an order win which could be stock moving?
So firstly, there's Bajaj Electrical, where its subsidiary, which is Bajaj Electricals, it has gotten an order of about 500 crores. And apart from this, I would like to shift to first. There's a Adani group of stocks that is going to be gaining focus. So firstly, there's Adani Enterprises, where the office of Hyderabad's regional director initiates investigation into Mumbai's as well as the Navi Mumbai airport accounts. Now, the documents pertain to FY 18 to 22, and this is much prior to when the airports were earlier acquired by Adani. Then there's Adani Ports, which has inaugurated its Vizhinjam transshipment container port, and this port will emerge as Kerala's largest private port, and it will also be a hub for supplying a lot of clean as well as green fuel. Now, then there's Adani's green energy update as well, where the sales was up by 87% year on year at 5.7 billion tons, and the hybrid energy sales was up by six-fold year on year to 2 billion units. Now, the operational capacity was also up by 24% year on year to about 83,000 megawatts. Then there's Tata Motors, where the company has agreed to sell about 9.9% stake in Tata Technologies. Now, of this, 9% stake sale will be to TPG Rise Climate, which is a climate-focused PE fund, and this will be for about 1,467 crores. Now, the stock was already up by about 4 to 5% on Friday, and it may possibly see some more of its upside. Then there's Mahindra and Mahindra, where the September sales was up by 18% at 73,000 units, and the September production was up by about 22% at 79,000 units. But the exports were, however, down. And apart from this, the income tax department has also filed an appeal which goes against one of the reliefs that the company had gotten with regards to a 432 crore tax dispute. So this is small compared to the size of the company. So the stock performance may more react with regards to a September update. Then there's Laurus Labs, where Immuno Act has received a marketing approval for Nexcar 19, which treats lymphomas and leukemia, which is basically a cancer treatment. Now, this approval it has received from the Central Drug Standard Control Organization. Now, Laurus has about 33% stake in Immuno, and it may possibly be active today because of this news. Then there's Delta Corp, whose unit Delta Tech Gaming has gotten a GST demand notice, and this notice is for alleged tax shortfall of 6,383 crores. Now, these tax demands are based on the overall bets rather than the revenue that the company actually gains. So the company feels that this is not accurate with regards to that, and said it is going to challenge this tax demand from the GST.
Right, I think, and apart from that, a couple of order wins also that you were talking about, right?
Yeah. I'll come back to that in a couple of minutes.
Okay. Yeah. So these are few of the stocks that we should be watching out for in today's session. But apart from this, a lot of earnings that we are tracking, apart from an HDFC Bank, let's just quickly pull them up on your screens. You have a CET, you have Choice International, Science, DLM, Federal Bank, to name it. Geo Financial Services is going to be interesting as well, Alex, in terms of Geo Financial Services, because clearly, you've seen with JFS where you don't know what the expectation will be in terms of the business. So that's going to be a question mark for us. But Tin Plate, Yatra are a few of the names that we will be tracking in today's session. Whereas if you have to look at the weekly data as well in terms of the numbers that will be announced from Nifty 50, you have a Bajaj Finance on October 17th. You have a Bajaj Auto, Wipro, LTI Mindtree, and IndusInd Bank as well. You have HUL, ITC, Ultratech Cement, and Nestle, 3 FMCG majors that will be announcing numbers on the 19th of October. And apart from that, you'll have a JSW Steel and ICICI Bank, Kotak Mahindra Bank on the 21st. So the entire list tells you the Nifty 50 companies that we will be tracking as well from an earnings perspective this week.
Certainly. And as I mentioned at the start, there is going to be a lot to track on the global stage as well that could have an implication on crude oil prices, on safe haven demand, and of course, risk assets. So watch all of those very carefully over the course of the week. We are very close to the start of markets, so do stay tuned. We've got lots of action lined up in just a few minutes. This is BQ Prime.